On today's show, three questions. Number one, what's the latest on the economy? Number two, can you define a bubble? And number three, are you on the hunt for a Labubu? Let's go. Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are. This is basically the Rabih and Matt show at this point. I can't get another advisor on the docket here, on the schedule. They're too busy. I've said this before, Rabih. It's really my fault. I don't plan
fine.
ahead.
It's fine.
I don't plan ahead. I just live my life in reaction mode. Like, oh crap, we have the client only huddle this week. Oh crap, we have another 2 cents and I haven't added another advisor. Oh, they're too full. Like, this is just my life, basically.
That's fine.
So
What are the odds that you have two people who are not opinionated at all on a podcast? We're fine. We're fine.
we seem to make it work. We're not saying it's good, but we certainly yap. My favorite is we'll be like, oh man, we don't have much to talk about today. And then we go for 45 minutes. Also, speaking of that, we'll give a quick shout out to my friend and client, Hunter. You know who you are. Saw him at the summit. He told me he loved, this is his favorite podcast, which I like of all podcasts, by the way, Rabih, which that I felt so good about that. But he was making fun of us at the summit last month. He was like, I love how you started out like early on, like 2 years ago. We've been doing this for 2 years now.
Mhm.
And he was like, you started out naming or stating that like the time you were going to go, like 15 minutes. He's like, and then it just like slowly started expanding and then you just like stopped talking about how short they were going to be. I'm like, yeah, we can't, we just talk. Sorry.
Yeah, I did not, think of that until now. I do remember. It's like, we're doing this for 20 minutes. It's for
He
your
remembers as
drive
well.
home. Now it is for your lunch, breakfast, and dinner.
Now it's for your workout or you go on a long walk. So anyway, here we are. Rabih, what is the latest on the economy?
Yes, so we've got a bunch of data points coming this week. And let's talk about them. It is very interesting because this is like a major batch of data before the Federal Reserve meets in 2 weeks on July 31st. The administration would love interest rates to be cut. The market has
Wait, what would give you that indication, Rabih? Threatening jobs and all that?
Just a hunch,
Yeah, just a hunch.
And the market actually is being more realistic, and they're only placing like 6% probability that a cut might be in the works. So if a cut happens, it would be a surprise. And the Federal Reserve, who is dependent on the data, is actually trying to find, a data-related justification for a rate cut. The data that came this week does not give him the justification to cut.
Way.
In other words, dude, American economy is unstoppable. So let me start sharing some data with you. So we got the inflation rate, core inflation rate, and it came in as the CPI, which July 2022 got to 9.1%. That was the one they were reporting on. And so far, we are at 2.7% year to year from like last June till this June. And this CPI number has been fluctuating between 3 back in January all the way to 2.4 in May. And now it's 2.7 in June. So if you can see, there's been a channel where it's stable between those two numbers, between 2.4 and 3, and every single month. This tells us that there is no trend in inflation. This tells us that we parked somewhere. It's in an equilibrium position. So given that inflation is not going down, aka the economy is not slowing down, and it's stabilized at a certain point where it's not cancer related to the economy. It's not like spiraling out of control. Do not touch it if it's not broken type of situation. Next we got was the retail sales. The retail sales are very important because those tell us how much consumers are willing to increase their usual consumption on retail products from 1 month to another. And given that the US consumer is 70% of the economy, this is a big indicator whether the consumers will lift the economy up or not. What do you guess? Did we lift the economy up?
I'm going to say yes.
We did. So they change and fluctuate month over month. It's interesting because they spiked up back in March, right before I'm not going to give you numbers to confuse you, but they spiked up in March, right before the tariffs, because people were hoarding, pre-ordering, making sure they go. And then in April and May, they were actually negative. So the year-over-year growth actually was like negative. I said I'm not going to give you numbers, and then I want to go.
You said you weren't going to confuse me, Robbie. You know how easily I get confused.
Okay. Forgetting about the numbers, in April they went a lot down, and in May they went down just slightly, a little bit, slightly below zero. And the consensus was that this month for June, the year-over-year growth is going to be like 0.1, 0.2%. So it's like kind of flat. And then it came in 0.6%, which
Don't make promises you can't keep, Robbie. There's no way you're not giving numbers. You're just giving
I'm
numbers.
sorry.
Just
I'm
call it
sorry.
out. It's okay.
Honestly, I do not know enough English words, so I have to throw in the number.
Yes, you're like, I can only speak in numbers. That's how my brain works. It's like literally zeros and ones. I'm a computer.
Yeah,
Yeah.
I work in bits.
Yeah.
So this is what we ended up getting. Inflation is going nowhere but stabilizing, so it's not problematic. Consumers are still spending really well. And the last data points that we get, they're not as important as others. Oh, actually, no. Before I go to there, we got initial jobless claims, which are, new submissions to get Social Security, which is an indicator that people are getting fired, right? It's telling us that people are spending more. So we would expect that they would not be fired. And the data supports that. In May, we had like 228,000 people apply for unemployment, not in May, last week. This week, they were expecting that we get 235,000 apply, but only 221,000 applied. So it is less by around 14,000 people, which is a healthy sign. And the market actually made new highs this week based on these data. People are still spending more, larger growth than we expected, less people applying to unemployment than we expected. So those were two healthy signs. And with that, we kind of are in a position where the Fed is not justified to cut rates. But we got two other data points that are kind of interesting, which are the changes in export prices and changes in import prices month over month. We were expecting them to be flat, but both import prices only increased by like 0.1%. It didn't increase by much, but export prices increased by 0.5%, while the consensus was that they're going to be dropping because the dollar has dropped. If you are going to be exporting outside, it is favorable for a foreign buyer to buy at a cheaper prices. The dollar is down, so the export price should be down. Surprisingly, the export price came up, which means although the dollar has been depreciating and it's better for a foreign purchaser, the prices in the US are still increasing at a pace that overwhelms that drop in the currency valuation. So it is interesting. Maybe only for this month, the tariff was supposed to increase prices on people in the US purchasing. It's actually what the shift that has been happening. It's increasing the prices on people buying American products from outside the world. But it's only for 1 month. I wouldn't want to exaggerate it. But that was the only surprise data point that came in. So given that, if the Federal Reserve decides to cut interest rates, it would be a surprise. The GDP estimation so far for Q2, according to models, not anything that's on the ground, is that we expect it to grow 2.4% annualized. In Q1, we had a 0.5% drop for Q1 on an annualized term. Q2, if it was down, it would be a technical recession. We're so not in a recession. We're bouncing back so well, 2.4% instead of it being negative. And earnings season just started. That is on an update from the equities market. The banks reported it's looking well. And it's looking well because we had some volatility in April, and banks really do really well when the market is, panicking because they can find really good prices. And the markets are hitting all-time high across the board. So a cut, I think not. The data doesn't support it.
Yeah. I mean, outside of the pressure from the administration, why would they? You just went through all these reasons that the economy and data points to show the economy is continuing to push forward. I mean, I think we just called the top here because you called it unstoppable. So those are the famous last words right before recession. But, as we've talked about many times on this show, that the Fed would only decrease rates if there was some worry in the economy. It's a stimulant effect, right? Trying to stimulate growth, and we don't need that. And in fact, the flip side of that, as we all know from the last few years, the biggest concern being inflation. So I do find it interesting, and it's not like I've seen this a lot out there, but anyone who's maybe supporting just politically maybe they're falling in line politically, rallying around this Trump call to cut rates, I would caution them to say, well, how did you feel 2 years ago or 3 years ago when we had what people were calling runaway inflation? I don't think it was really that, but we had pretty major inflation. That is the main concern right now of the Fed.
It is. It is balancing the needle because that number is 2.7, right? And that's CPI and that's headline. Like we're still a little bit far away from the 2% target on the core that they were talking about. So is it job done? I would say 90% the job is done. Did we achieve a soft landing? Yes, we did. Great job. If you cut interest rates right now, probably like one cut is not going to move the needle, to be honest. Maybe just the market will be happy, it'll go up, but that's about it. I don't think it'll have systematic effect on inflation immediately because expectations are well anchored. They know that this Fed is stubborn type of thing, and they're not going to compromise on it. But the idea is unemployment is not taking a hit, and inflation is 90% done. We know we're in a restrictive stance because 4.5% is high for this economy. But do we have to do it right now, or can we wait a couple of months before doing it? The expectations are that in September we're getting the cut.
Yeah.
And if the economy stays where it is without, and the cut will be there just because we want to move to a more neutral monetary stance rather than there's something wrong and we're trying to fix it with lower interest rates, that would be very bullish for the markets and higher returns. You will definitely cement the idea that we're ending positive for the year on the markets. Your prediction.
Yeah. I mean, I'm just saying, I don't want to call it I don't want to call it too early, but feeling pretty good right now. Uh, and Rabih, you said something interesting there. What would we even say the Fed funds rate is quote unquote high right now? Like, I don't know where it lines up historical averages, but isn't that also like a relative term when we have a normal yield curve that we do? Like, would you define the Fed funds rate as high or just relative to what it was for 10, 15 years?
It's a mistake if we compare it like we compare other data points, as in what it's not like you're comparing your mortgage rate now versus 10 years or 15 years ago, because it is dependent on the context that it is in. There's a formula for it. The Federal Reserve uses it. It's called the Taylor's rule. And for them to decide on whether the interest rate is considered high or low or neutral to the current regime and the context that we're in, they measure it to one, what their current target is, and their target is a 2% growth in the economy, and their inflation target, which is a 2% inflation target. And on top of that, where we are right now. And they try to balance these together without going into details. And based on these numbers, they know whether we're in restrictive, easing, or neutral position. And right now, given a 2% target on the economy, and we might expect to get like 1.7, 1.6 on the economy this year, it is considered restrictive. But a 4% interest rate, talking back in the 70s and 80s, that is easing. That is not restrictive. So it really
Yeah.
depends on the context. And so far, it is restrictive, but it's not restrictive to a point where, we are pushing the economy into a recession ourselves. Back in the 5% level, it would have been, think of it, you're on a treadmill running at 4.5 instead of the 3 that you used to walk. If you've been doing it for 2 years of non-stop jogging, you are tired a little bit. It is restrictive, but it's not going to break your leg while you're on the treadmill.
Yeah. Yeah, I think of it kind of like the governor on an engine, right? It's they're trying to keep it at a pace where we don't go too fast. Because to your point, the consequences of growing too fast, we've seen what that can be. Not even just the last few years, but like you referenced the 70s and 80s. That was true runaway inflation. There's other historical examples of other countries that have seen this. So I love that you just went through that. And I think that's really important. Like the context matters. The relativity of other factors of where that interest rate is matters. And I love that you used the mortgage rate example because right now mortgage rates feel really high because we're comparing it to what it's been the last 10, 12 years. I just talked to a client yesterday, by the way, 2.63 mortgage percent. We were looking at a whole other conversation, but I looked at it. I'm like, this is wild. And it feels crazy low because we're looking at where mortgage rates are now, but mortgage rates now are actually pretty historically normal. We're actually in a normal range right now. This is where it's been for a long time, 5.5%, 6%. Like that's average.
Yeah. And
So
the
it's
context, though, very high prices, not
that's
enough,
the
a lot of buyers, not enough
yes.
supply. It feels expensive.
It absolutely does. And that's a whole other discussion of where real estate is and how I think that has a lot of ripple effects of like how people feel about the economy versus how the economy is actually doing. I think a lot of that comes down to just real estate. We've talked about this before, but one other thing I wanted to bring up, Rabih, really quick on the economy, you mentioned some of the surprising numbers. One thing we referenced, I think it was last week or the week before, were the data points around the tariffs and the result of the tariffs. I don't have it in front of me, but I saw that June, I believe, came in at another surprising surplus. Can you talk about that a little bit and just what we're seeing there?
Yes. So actually, that data point was released the same day after we did the
Oh
podcast.
yeah,
So
you messaged me.
we
That's
couldn't
what.
catch it. We couldn't catch it
Yeah.
in time to be on air. I'll have to call, like, I don't know, the Treasury Department and tell them, hey, release them early
Hey,
just for this podcast.
pump the brakes, guy. Or, yeah, exactly. We're breaking strikes. We're talking about surpluses. We need the data now.
Yeah, don't you want me to talk about it? Like, what
Yeah,
are you doing?
yeah.
Click the button. Anyway, the data was that in April, we were in a surplus just because it's a tax month, right? And a lot of money comes into the government at that point. And it wasn't unclear. In May, we had a deficit, but the deficit was much smaller due to money coming in from the government, from the tariffs into the government. It wasn't the $2 billion a day. It was more like 500 million a day. So it did some success, but very controlled, not up to the big expectations. And then in June, we were expecting like another deficit, and it came in as a surprise surplus. Will 1 month change the whole narrative? And we're now putting this period similar to Bill Clinton's 93 when the budget was deficit was balanced, and budget was balanced? Not really. But that's one good point. And hopefully it continues. It came and it was due to lower imports, higher exports. It was due to tariff impact.
Do you know
So
the
let's
size
see
of
how
the
that works.
surplus, Robbie, in June?
I can pull it up if you give me a second.
Sorry, I can just sing a song or something if you want.
Let's see. Monthly budget statement. And it came in at, oh, it is very low. I'm sorry to tell you that. But it came in at a 27 billion budget surplus in June.
That's nothing.
Yeah, because
I'm just kidding. That seems like a big number, but
it
I
is
have
not,
no
because
idea.
in April it was 258 billion, right? In May it was a surplus. In May it was a negative 316 billion. So if you're fluctuating in the magnitudes of 100 billion up, 100 billion down, at 26 billion on its own could statistically not be very different than zero.
Got it.
So we're flat, but
Yeah.
better than having a deficit,
I
right?
was gonna say we take the win. We'll take the win, and hopefully this trend continues. It'd be great, despite the. We try to look at this stuff as objective as possible and truly keep politics out of it and our personal opinions of politics out of it. But the data is the data, and we'll take the win when we get them. And I think the biggest surprise was that we were expecting a deficit, even though it was in the grand scheme of things maybe a rounding error, but it's better than going negative by 300 billion. So we'll take that. Okay, awesome. Robbie, anything else you'd add on the economy or the markets, anything like that?
More to come. We'll see, but
Yeah,
this is where we stand and it's looking good.
always more to come. Okay. Can you define a bubble? So this is not exact. Well, this is kind of pertinent to what's going on right now. There's been a lot of talk, I think, around AI and are we in an AI bubble? I got asked recently a couple of different times from a client and friend bringing this up, like what is a bubble? And I thought it'd be a worthy review and discussion, and then get your take, Robbie, if we are in some sort of bubble when it comes to AI. You know, and there's so much nuance to this. This is probably like a standalone podcast around when we talk about AI, like what does that even mean? Like, are we talking about AI companies? Are we talking about the technology itself? Like, there's just so much nuance, I think, to that. But I think it'd be good to talk about what is an actual bubble. So, and Robbie, I know you'll have a lot of thoughts on this. But I found a quote from Cliff Asness that I thought was a great place to start with this, which is he describes a bubble. The term bubble should indicate a price that no reasonable future outcome can justify. What are your thoughts on that, Robbie? We'll start there.
It is interesting because he is starting from the end of where I was thinking. Because in my mind, a bubble starts with there's a craze, there's a hype, everyone is flocking, there's fear of missing out, right? And then a sudden collapse at a point where the price does not justify any future outcome, right? So for me, a bubble is much earlier, when people are just very excited about something, herding and flocking towards something. He is defining it as the endpoint where, this is the price that would crash. It is an indicator of a bubble. It's
Yeah.
interesting. Yeah.
Yeah, so let's talk. You just mentioned it. Let's talk about this. I found this is from the book Manias, Panics, and Crashes: A History of Financial Crisis. This is by, if you're interested and you want to read it, it's from Charles Kindleberger, and he talks about he breaks down what you just said,
Mm-hmm.
the phases of a bubble. So let's go through this. I think this would be helpful. Phase one, he calls it displacement. And by the way, this is from Ben Carlson, kind of summarizes these phases from this book. So we've mentioned Ben Carlson and his work before. They do fantastic work. So this is from Ben Carlson, kind of summarizing this book. So phase one, displacement. So an event or innovation occurs that sharply changes expectations. This phase is typically grounded in reality and good intentions.
We're
If
here,
we're just
right? We've
we're
already
there.
covered this point. Yep.
Yeah. So let's apply. I like this. Let's apply this to where we're at with AI. Phase two is expansion. So this is the stage where the narrative takes hold and people begin bidding up asset prices.
I would think so, but I would be very cautious. I was actually looking on some data and it was very interesting. They were comparing the allocation on sectors in small cap, aka what is the percentage of small cap that are in tech companies, in utilities, in healthcare, etc., versus what they think, because it's not really public data, the allocation of private equity investments into these sectors. And private equity is a much smaller company size than small cap stocks that are on the stock market. And there was a big skew, probably like 30% of the companies that belong to small cap indices belong to the technology sector, whereas in small cap, it's around 70 to 80% and PE. So private equity is investing much, much more heavily in technology companies than what the allocation in small cap looks like.
So what story does that tell as
What
far
that
as
story that tells is that with smaller companies, with upcoming startups, they are bidding more, which is your point, on those tech AI companies than what we see in the market.
got
I
it?
would be fearing if suddenly the small cap sector is small cap universe of securities is 80% weighted in technology companies. And then if the large cap and the S&P 500, we know right now, like the Magnificent Seven are like 30% of the index. But if they get to like 50% of the index, 60% of the index, that would be very 2002.com period, because
Got it.
everyone is just invested on it, not just the sector. And in this case, it's the startup vibe fully invested in it.
So what I'm hearing is, if we're talking phase one displacement, we agree we're there. Phase two expansion, it sounds like what you're saying is based on the numbers. We're probably not. We're somewhere between phase one and phase two.
We are in phase two, but phase two comes in stages, and those stages depend on where the money is being funneled in compared to the company size. And we're still at the beginning of.
Got it. Got it. Phase three is euphoria. So by this point, all bets are off. Everyone assumes they can get rich easily and very quickly. I think when I hear this, I think the most obvious recent bubble was crypto in 2020,
Yeah.
NFTs, all the SPACs, all that stuff. Risk is taken with abandon and nobody worries about the hangover in the morning. This is directly from Ben Carlson. During the dot-com bubble, this is the point where people decided they could make more money day trading IPOs than going to their day job. I don't. This is probably from someone else. I have no idea. But I said this a long time ago, a few years ago. I kind of call this the Uber driver index. Like when you're Uber driver, like you're in euphoria when you're taking an Uber driver or Uber ride to the airport, and your Uber driver starts bringing up the SPACs or IPOs or the crypto or whatever. And it's like, okay, this is a problem. We are in the middle of euphoria. So euphoria makes people think the good times will last forever, or at the very least, they won't be the ones holding the bag when it turns. So go ahead, Rabih.
just to give you something that resonates with it. And Daniel Crosby, Dr. Daniel Crosby, in his book did mention something about bubbles in that sense. And I think it's the period 3, the euphoria. And he said, I really love this quote. It stays in my mind. A bubble is when your time frame for a long-term investor starts shrinking and shrinking and shrinking. So in stocks, you hold them for 30 years and 20 years, and that's when you make money. But when your time frame for holding a stock drops to 1 year to 6 months to 3 months and thinking that is enough for you to make your money, that is when it is a bubble, because the property of that investment is for it to be a long-term horizon. If the horizon is shifting, it's not that product is changing, it's that you are in euphoria.
Your approach to it has changed. Yeah.
Yes.
Your mindset, the way you're using it, your time frame. I love that. You start swinging for the fences. Yeah.
That's a bubble because
Yeah.
everyone would be doing it, and then the ball is dropped.
Yep. I don't think we're here yet. I don't think we have any indication that if we're applying this framework to AI right now, I don't think we're there based on this description.
No, it isn't. Something that's very interesting is that most of these AI companies right now they're not like public companies on the stock market for you to like feel the craze. In the .com, if you remember, every single day you've got a bunch of companies just being listed on IPOs. We call them zombie companies. They didn't have profit, they didn't have earnings, they didn't have anything. Probably number of clicks on a website, and that was enough to list them on the stock market. People were bidding based on nothing. Right now, we do not have the companies that are online. We've got them as part of bigger companies. You could look at Gemini, and it's a small section of Google, which is already established. Look at OpenAI, which is a section of Microsoft that's already established. And on top of that, OpenAI is considered a nonprofit legally. So there isn't like return to shareholders. It's not expected to raise the stock price.
Does Elon Musk think it's a nonprofit? I think he might have some.
I think it's part of.
Yeah. No, I'm saying Elon Musk and Altman have been feuding about, and
It's
Elon
still,
came out about all that.
yes, but it's still considered a nonprofit legally. So that fight didn't go anywhere. So and Grok or Grook, I think the name of it, which is it's part of X. So it's interesting because this new technology is emerging. It's like, the bigger company is pregnant with this new technology rather than these new technologies popping up out of anywhere.
What an analogy, Rabih.
Yeah,
We've been talking about kids too much. It feels like
I
in the
know.
office.
I know.
I said I'm on a mission for Rabih to have kids.
Oh my goodness.
Okay. Phase 4. So let me just, we were phase 1 displacement, phase 2 expansion, phase 3 euphoria. Phase 4 would be crisis. The inevitable other side of any boom is a bust. I love what Morgan Housel says of like the seeds of any downturn in the market are planted in the upturn, to paraphrase his words. But the inevitable other side of any boom is a bust. This is the phase where the insiders begin selling and panic buying quickly shifts to panic selling. We're certainly not there. And then phase 5, contagion. Just as prices overshoot to the upside from euphoria, they often overshoot to the downside. Weird. Once the contagion of bad news spreads and people think things will never get better again. So I think, again, if we're looking back of this, if we're just applying this to like what's happening with AI, I feel pretty good with what you said, Rabih, like somewhere in phase 2, probably early on in that expansion phase.
Yes. And I think the most important part is the last part, which is it crashes, but is there contagion? Because that is what's going to determine whether, it's a bubble that popped or this is a widespread downturn. This is what causes a recession. So in 2008, we had a bubble in the real estate market, but it hit the banking sector because of it. It was contagious. It made credit spreads go up. It was very hard for, I don't know if you've seen from The Big Short, I think the movie, is that like McDonald's are calling the banks like, you guys need to give me my money to pay salaries out. So it was stemming from real estate to banks to the other companies that depend on the banking sector. And that is when, a severe recession happens. But NFTs dropped and kind of disappeared for a while, and they didn't really affect anyone because it was contained. That is the main important part, and this is where, for someone who is not participating in the bubble, like Bitcoin has reached 116, and you are still on the sideline because you do not believe in what they are proposing. Good for you, but so far, if Bitcoin crashes to zero tomorrow, I think other than MicroStrategy, no one will be affected, right? So it does not pose a systematic risk on the system, which is a good thing. If those crazes want to show up, let them show up. It's part of the markets, as long as it doesn't hurt everyone on its way down.
Yeah, I think that's a really good point, Rabih. So to summarize kind of this whole thing and what you just said there, and the analogy of the companies being pregnant with babies, I think what I'm hearing, and tell me if I'm wrong here, if I'm missing anything, you're saying when people worry, like, are we in an AI bubble? Number one, just to go backwards, you're saying it's contained. So right now, there's no evidence to show this would be the equivalent of like the impact of the Lehman Brothers and the contagion effect that had because it was the entire system. This is far more contained. And then the other piece that you highlighted, if I'm understanding this correctly, is that AI, like if we compare this to the dot-com bubble, it's not even close to the same thing, really. Like these are technologies within companies and tools being born within companies that are helping those companies. But it's not like there's this like massive blow up of like, here's 200 fake AI companies that you can invest in. Like that was what was happening in the dot-com bubble. So I'm hearing from you, it's contained. And it's really just it's not even the same thing. Like AI is the overall narrative for sure is AI, but it's not AI companies. It's just AI as a technology.
100%, and it's due to the economics of it. How hard to train a model to come up with something like ChatGPT? You need to train it on around $1 billion worth of data and operations. That is not something that someone can do in their garage. But in the bot.com, all you had to do was create a website. That could be done so cheaply. So there are more of like systematic stuff about the economics of it that do not make it blow up in flames and rage as quickly up and capture everyone's attention as fast, just because it's a harder barrier to entry.
Yeah. Okay. I love that. Anything else you'd add to the bubble topic? Hopefully we did it justice.
No, I like it.
We're going to shift gears to, I think, probably, I dare say, one of the most important. What?
The most important topic.
I think the most important topic, certainly of this show, but maybe since in the history of 2 cents. Rabih, are you on the hunt for a Labubu? Is the question. Here's the real question. Did you even know what a Labubu was before Becky, Studi, and Michelle informed us?
No idea. And I Googled it, saw the picture, and I was like, yeah, I've seen enough. I did not even go to read.
So it's funny. I will be vulnerable here and share a little personal story here, a little tidbit. I actually call my daughter sometimes Boo Boo. So I'm like, hey, Boo Boo. Or Minnie, which I'm kind of taking advantage of the dad of a 6-year-old, calling her what I like, those cute little names while I can before she starts yelling at me as a teenager and telling me to stop. So I'm taking advantage. But when I heard that, I was like, I immediately thought of that. And then to your point, I had no clue what it was. So I went to look it up and I immediately thought of Beanie Babies. That's really what they are. So I grew up in the 90s when Beanie Babies were huge. They were all the craze. Rabih, I know you probably don't remember this. You're too young of a pup, but Beanie Babies were huge and people were trading them and there was articles written about them. I actually don't know how big at its peak it got, but it was huge. It was like huge craze. So I immediately thought of that. Well, Labubus are basically the same thing, just the new version. So Rabih, I went down a rabbit hole on this and I want to actually make this relevant to, all jokes aside, make this relevant to investing as much as we possibly can. So as I was going down this rabbit hole, I actually found in this article, shout out Becky, she actually sent this, that Rabih, have you ever heard of the lipstick index or the lipstick effect?
Mm-mm.
I hadn't either. So this is such a manifestation of how much we hate uncertainty that we will create index upon indicator trying to grasp for control of what's going to happen in the economy and market. So basically what the lipstick effect is when consumers still spend money on small indulgences during recessions, economic downturns, when they personally have little cash. So they don't have enough to spend on big ticket luxury items. However, many still find cash for purchases for small luxuries. So this was created in 2001 by Leonard Lauder. He coined it the lipstick effect. And basically, again, saying when times are tough, lipstick sales are on the rise. Again, I could not help but think that we just want control so badly and hate uncertainty that we're literally making stuff up all left and right about this stuff. But the reason I bring that up is some people are pointing to this Labubu craze as kind of fitting within that index. So I'm going to leave it there. I want to get your response first to any of that.
I'm trying to, I just discovered this concept of Labubus,
Yeah.
and the way my brain works is I'm trying to find a place in my brain where it fits into the narrative, right? So
I'm buying you a Labubu for Christmas, by the way,
I
just
love
so
it.
you
I
know.
can't wait. Best Christmas ever. Anyway, this falls under the category of discretionary spending, right? I do not think you need Labubus to survive, although I think Studi would say differently, but that's a different conversation. So that falls under the category of discretionary spending, which we know is a good indicator for economic health, because when times are tough, people start cutting down on discretionary items much faster than, necessities, even if the necessities are big item tickets. But within the discretionary income, the discretionary spending section, there are stuff that you just cut down because it makes sense to you, and other that you double down on them when uncertainty is high, which is very similar to the lipstick situation that you mentioned. During hard times, you can't afford a vacation, but you need to feel that you have a sense of control. You can control you can control your leisure in life. It's not that it's being forced upon you by the economy. So you go get the lipstick.
Or
Example,
the
I'm a
Labubu.
Labubu. Example that came to mind, given that I'm Lebanese and just, there was a war. Do you see all the videos of like rockets flying and people were in a nightclub partying? This is the same exact
Yeah,
thing.
you
It's
you
like, we
showed,
might
yeah.
die tomorrow. I want to enjoy my time right now. This
Yeah.
is the exact same thing. So probably a lipstick and a Labubu and, partying under rockets, or fall under the idea that I'm supposed to be cutting discretionary spending, but the pain of consolidating my financial position far outweighs the economic harm I'm going to get by purchasing that thing. So I go and purchase it. Do these stuff actually indicate that and this is my opinion over here. Like, do these stuff actually indicate that, the economy is treading in a wrong direction, or there is an actual slowdown? I would say not, because there is a separation, and we've covered this multiple times, between people's reaction to what is happening in the economy and what is actually happening in the economy. Right? If those are aligned, then yes, it's a good indicator. But because there could be this mismatch, it's not as reliable as we'd like it to be.
Yeah, most of these things are not as reliable. They're fun to talk about, and it's fun to have a new index to talk about, but most of the time not super reliable. Although I will say, by your description, Rabih, so to give more details on what these Labubus are, again, I reference Beanie Babies. They're basically these furry little guys, furry creatures that you like clip to your bags or something. They got really big because Rihanna. Okay, we're gonna get so made fun of. The only person on this list they list that I in this article that I know is Rihanna. Love myself some Riri, but the other ones, Peggy Gao and Lisa from Blackpink, I have no clue who those people are.
You're not alone. Me too.
Yeah, okay, perfect. Michelle and Studi are gonna rip us apart in our Slack channel. But apparently they've started like wearing these on their handbags and they've gotten really popular. But Robbie, come back to your description. So these were made, this is a Chinese brand. And I know the Chinese economy far different than what we're dealing with here in the US. A lot of indicators of major economic slowdown. There's been some things coming out of there for the last couple of years. Obviously, they've issues of like how they've not been able to recover from COVID. So maybe this does fit for specifically the Chinese economy. Just for some numbers here, in the past year, this brand has grown 727%. So it is now up to almost $420 million in revenue in US dollars. 420 million in 1 year in
Wow.
Labubus. They're like impossible to get, apparently. And I guess one of the things they do as well, Robbie, that is different from Beanie Babies is that they're like blind boxes. So you buy them, but you get them if you can, but you don't know which one you're getting.
In the
So it's
box
kind of
until
like
you
what they used
open
to
it.
do. It's what they've done with like these these cards,
Yep. Baseball
basketball
cards,
cards.
Pokemon cards. Yep.
Yeah, Pokemon cards. You get like these drops, as they call them. That's kind of become the new craze. So they've started to become more mainstream. They're like sold out everywhere. You can't get them. So the question, the people that they're saying some of these stores now, people will be up or going to these stores overnight staying overnight, camping out, trying to get these Labubus. So, Rabih, the question is now again: are you rushing out to get one? What I want is for you to get a Labubu, and you don't have a handbag, I don't think, but either A, get a man bag, or B, clip it to like your pants. And you just have a little
Next
Labubu
to the
hanging off your
keychain.
pants. Yeah, so you're just a little buddy. So anyway, any other final thoughts, Rabih, on the Labubu craze or the lipstick index or any of this ridiculousness that we're finishing the show with? If anyone's even still with us.
No, it's fun. I honestly, so young boys who grew up like opening Pokemon cards, Yu-Gi-Oh cards, baseball cards, they've come up and they're probably more prone to be addicts, right? So just because
Wait, is that like a fact, or you just are you just like speculating?
I'm speculating. No, I'm not speculating. But the idea is that thing that started with the childhood is still like the fact that Pokemon cards still exist now is because those things started when kids enjoy them, then they were wrong. And it's same. Here's not what I'm speculating. It's the same psychological effect. You're receiving something that is. You're hoping you're gonna get something just based on probabilities. There are people highly in debt just because they go into this cycle of purchasing it, hoping they'll get something that is gonna break even or just make their money back, and it goes into a downward spiral. It's a behavioral hack and it's getting abused. So it was usually constrained for little boys, and now with those Labubus, I do not know if they're unisex, but I think they're targeted towards girls. Would that actually now be indoctrinating the girls into this addiction cycle with collectibles? That might be something that I draw a question mark on.
Yeah, we will see. We're going to continue to track the Labubus. I think we'll make sure, like tariffs and inflation and interest rates, we will start tracking the Labubu craze. And if it continues to, maybe we're in a Labubu bubble. I wonder what phase we're in with that when it comes to, because it feels like maybe we're getting to euphoria stage.
I can't wait until my Uber tells me to buy a Labubu from
A
them.
Labubu. Well, to be fair, it has not gotten to, if we're going to use 2 cents, Rabih and Matt, as the indicator of where we are in that phase, we had never heard of them. So we're not there yet. That would be like the peak of the bubble, I would say, as we start to hear them. So maybe we are now because we just heard about them. Okay, Rabih, if we finished it out with a great topic there, again, if you're still with us, we appreciate it. If you ever want to talk to us about Labubus or otherwise, we're here to help. DentistAdvisors.com. Click on the book a free consultation button. We'd love to talk to you. For now, again, thank you so much for listening. Rabih, thanks for being here, sharing your wisdom. That was our 2 cents. Till next time. Bye-bye.